Inflation is often oversimplified and manipulated to fit narratives of financial news, reporting, and banking. Often kept artificially low to trick the public into thinking that their standard of living has remained relatively the same, while in reality it has degraded and shrunk. Today, we're going to break apart inflation, look at its greasy underside, and see how our purchasing power is being sucked away by a failing currency and an increasing population. Specifically, how real inflation is something we are ineffective to combat, and that the consumer price index is a managed figure to keep inflation artificially low and to keep you calm, and that the third hidden inflation that's going to flip the world economy. First, let's start with real versus transitory inflation. Inflation is often oversimplified into a single percentage. However, in reality, we have real and transitory inflation. Real inflation is an increase in demand leading to a higher sustained price, like a higher population demanding more goods. Transitory inflation is when an event causes temporary inflation that will eventually go away because there was not a real change in demand. Supply shocks, like we see in the silicone shortage and the prices of GPUs. For now, we are going to leave transitory inflation alone and focus on real inflation. Now, in general, economists do not like to talk about real inflation, mainly because they're absolutely useless at trying to fix it. Real inflation is affected by core demand for products. As demand increases for something, then so does the price. Our business world has gone global, so does our concept of real inflation. No longer are domestic goods meant for domestic markets. Instead, we are governed by global demands, and they are getting demanding. Looking globally, we can see a rise in a few key factors. Populations continue to rise, which leads to an increase in demand to provide essentials for new individuals, something globally that we are failing miserably at. Second and third world countries continue to develop and are modeling their growing lifestyles on what has been advertised for years in America and Europe, leading to increased consumerism for goods as new countries begin to modernize and enter the global market. Our first world countries continue to consume at alarming rates, and it does not seem to be slowing down as many continue to idolize the top consumers in their countries and try to model their lifestyle after them. These types of issues are global issues and require much more than graphs and charts. So let's get creative and see what kind of solutions we could find to solve real inflation.
Concentrate. There. You've got it.
Well, that could work, but I really hope we can do better than random genocide. An alternative would be to change the demand of essential goods. Some have attempted to change the type of demand, such as switching from beef to vegan or bugs. A change in consumer demand to more sustainable products would improve real inflation. However, these types of changes are social and take a long time to implement. We could also go with advances in technology, construction, or agriculture to be able to provide more goods to people at a lower cost. Effectively, it would increase the supply of goods and decrease the price. These are great fixes, however, they take many years to develop and in some cases could be impossible. The most efficient current manner is to fix our supply issues, is to begin looking at the global and local supply chains to begin eliminating as much waste as possible. For example, in agriculture, we produce enough food to feed 10 billion people a year. However, we have a mass starvation occurring when our population is only at 7.6 billion. An estimated 30 to 40% of food produced is wasted. It is obvious that we need to be more efficient with our resources instead of demanding more of our resources. By addressing the 30 to 40% of food waste, we could dramatically drop the price of food globally and feed everybody. But we have to learn to share. Oops. So, transitory inflation is more studied by economists because it can be easier quantified and qualified. This is a temporary inflation caused by a shock in the supply chain or a sudden change in demand. A good example of this is the current circuit board and chip issue that is driving up prices. We have a supply shock due to a global pandemic causing a shortage of silicone, a crucial part of chip production, an increase in demand due to cryptocurrency mining, and then people buying graphics cards for entertainment during their lockdowns. This has caused a large price increase in graphics cards and other products that use microchips, such as cars. Economists like this type of inflation because it's easier to package, explain, and sell to headlines. Transitory inflation is more observable because it is a sudden skyrocket. As such, it's attractive to talk about because it grabs everyone's attention. The thing is that it's not what's really driving our inflation forward. The real inflation kicker is actually real inflation because it's harder to combat, but it's slower and less attractive to talk about. So, how do we attempt to even measure inflation? Well, inflation is calculated by taking the average household's bundle of goods, the items they purchased during a year, and tracking the changes from year to year. Usually, a base year is set to compare how prices have changed and adjusted since that base year. There are arguments for and against CPI, and I am only going to highlight a couple of the biggest ones. When banks, governments, or economists talk about keeping the inflation rate at 2%, they are not talking about all the goods a household would purchase. They are talking about the CPI bundle of goods, which excludes food and gas, because their prices are too volatile. In other words, food and gas prices change too much. This is a huge flaw, as food and gas are very price inelastic, meaning when the price changes, the demand doesn't. Gas prices go up, well, you have to keep buying because you have to go to work. Food prices go up, well, you may switch some foods or cut back on treats, but you're still buying food. As such, a change in the price of food or gas is going to have a very drastic effect on your budget. So keeping these items out of the standard CPI keeps inflation artificially low because you do not track two staple household items. Inflation and the CPI are looked at as a measure of standard, how population can live and thrive in a country. This is actually far from the truth. Besides food and gas, the CPI does not include things like a retirement fund. If you are able to just afford the basic CPI bundle of goods, it is likely that you are cash strapped and maybe never see a future retirement. If you are living to paycheck, or worse, using debt to supplement your lifestyle, every increase in inflation is a direct decrease to your standard of living and ability to retire. There's one last item that is currently threatening the value of your currency more than anything, and it is the changing standard away from the US dollar. Since the rise of the modern economy, it has always relied on the USD to be the global currency, to be relied upon and trusted by the entire globe. Remember, the dollar used to be backed by the gold standard, meaning each USD was backed by an equivalent value of gold. This standard was abandoned, meaning the USD is only worth what you think it is. So, what happens when the globe no longer trusts the USD to be the reliable exchange of value? Well, holders of that currency will exchange it for something else that they consider to have value. Maybe another currency, maybe cryptocurrencies, gold, silver, maybe some goats, Pokemon cards, N64 cartridges, I don't know. But this will have an implication on the other holders as it will increase the supply of the US dollar and decrease the value of it. This has begun to happen with Russia and El Salvador moving away from the USD standard and removing the US dollar from its crypts. This moves the US dollars that Russia and El Salvador has into the global money supply. If more countries, companies, and individuals do the same, the global supply of US currency could increase at a rapid supply shock. Essentially, too much US currency. Combined with the US policy to continuously print cash, this could lead to massive hyperinflation, driving the US currency to below record levels. This does sound catastrophic, but one must be aware of the global risks. If we begin to see more headlines like Russia dropping or removing their US reserves, we will expect to see a sharp, sudden rise in inflation. So inflation is used to make a number of government and business decisions and it is an important part of managing an economic system. However, we must demand improvements. Instead of having a CPI measure, switch to a COLI, a cost of living index, to measure your country's inflation. A cost of living index is exactly as it sounds. It is a household bundle of goods that includes all the CPI items plus food, gas, and investments aimed at retirement. Tracking a COLI would more accurately show how inflation would affect the living standard of a population of the country and allow citizens to work towards a bundle of goods that would allow them to retire and enjoy life. Now, CPI is measured at the retail level. After the item has been raised, manufactured, or produced, then brought to the store. Now, this is a very late indication of what the price of that item is going to be. In fact, we already know the price of the item on the shelf before it's even purchased. As such, our current way of measuring inflation is very irrelevant, as the inflation measured actually occurs months before it hits store shelves. If we look at commodities markets, these are markets that track bare essentials of life like gold, rubber, oil, wheat, pork, beef, etc., and occur at the production level, not the retail level. As such, if production prices rise, we know retail prices will rise as well, as the business and production need to make a profit. If we use our new COLI to track commodity prices, we could have an early warning system that warns us that prices of items are increasing and not notify it after the increase has happened. Finally, and more drastically, we may have to remove essential goods from the thing that gets affected by inflation: money. This would be a bit of an overhaul and could warrant its own episode, but essentially it's removing profit margin and inefficiencies by making food an essential good and service that you don't pay directly for from our food supply, and would allow farmers and government to work together to deliver food to people in the most efficient manner, attacking and eliminating the 40% of food waste created a year. So, what can we learn? Well, the old adage of saving all your money into a standard bank account is well dead. Sure, having money on hand for emergencies is essential if you can avoid living paycheck to paycheck. But if you have money beyond that point, get rid of it. Invest it. Buy something. Get some Pokemon cards. Who knows what's going to go up in the value, but we for sure know that the value of your currency will always go down. So buy something and hope that you pick something good. Now, if you made it this far, like, subscribe, comment below, and we'll see you on the next video.